Good afternoon. I'm Shannon Derejo from Creamer Media. Welcome to our webinar on gas, where our panel of experts will unpack the gas projects, policies, and infrastructure needed to avoid the supply crunch. Today's webinar is brought to you by SLG and Richards Bay Industrial Development Zone. We thank them for their support in making this webinar possible. Before we get started, please be aware that we've enabled the Q&A function, so please post any questions into the Q&A box. You'll find this on the panel at the bottom of your screen. The panelists will answer as many of your questions as possible throughout the discussion. To encourage interaction, we've also enabled the chat function, so you can network with the panelists via the chat box. You'll also find this at the bottom of your screen. Please do not, however, post any questions in the chat box as we may miss them. You can post your questions into the Q&A instead. Please be aware that we are recording this webinar and will send the recording to you when it's available. We're also streaming the webinar live on YouTube and we'll share the link in the chat once it's available. Today's webinar will be facilitated by Jaco Human, Executive Officer of the Industrial Gas Users Association, Southern Africa, as well as Chair of the Busa Gas Energy Subcommittee. He provides leadership to industry on gas energy availability, policy, and pricing. Jaco will facilitate the discussion with our panel, which includes Mzitya Kolo, Group CEO of SLG. James Mackay, CEO of Energy Council of South Africa, Paul Erdley Taylor, Gas Sector Lead at Standard Bank, and Professor Samson Mampele, Head of the Energy Secretariat at the South African National Energy Development Institute, or SANEDI. I'll hand over now to our facilitator, Jaco Human, to continue with the proceedings. Over to you, Jaco.
Shannon, thank you very much, and thank you for arranging this very topical discussion today. And especially special thanks to, of course, Engineering News, SLG, and the Richards Bay Industrial Development Zone for facilitating this. It's really a privilege to be here. I see we are over 300 participants in this call, and certainly everyone in its own right is absolutely very knowledgeable of what is happening in the gas space, but we are particularly privileged to have a good panel of experts here, which I'll introduce very shortly. Maybe just by way of a bit of a scene setting or a few opening remarks. Of course, in South Africa, we're finding ourselves at a critical energy crossroads. On the one hand, we are not generating sufficient electricity to sustain economic growth, and of course we're sitting with the aging generation fleet at the same time. On the other hand, if you consider all the policy documents and conversations unfolding at policy level at the moment, we are certainly pivoting towards a more renewable and gas-reliant economy. Of course, currently gas demand sits about 180 petajoules per year, but in the next decade, that figure could rise to some 700 or 800 petajoules per annum. This growth will be driven both by industrial demand and, of course, power generations. If you consider, on top of that, the draft Integrated Resource Plan of 2024, it certainly backs this outlook, proposing 18.2 gigawatts of gas-to-power capacity needed by the end of the next decade, which translates over and above our growth projection numbers by an additional 300 petajoules of gas per annum. The outlook for gas, of course, is substantial. We see that across the spectrum at the moment in terms of industrial demand, power generation demand. But of course, there's a major hurdle. We are heading towards a gas cliff on the one hand. Our current gas supply is depleting fast, and we lack both infrastructure and confirmed replacement gas. Of course, the economic and industrial risks speak for itself under the circumstances. So today we're really going to contemplate and ask ourselves, how do we bridge this gap? And of course, how do we secure supply, attract investment, and align infrastructure and policy to avoid this crisis? So I'm very happy to be joined by our panel of experts, and allow me just to introduce them very briefly. So Professor Samson Mampweli, head of the Energy Secretariat at SANEDI. Professor Mampweli leads the key national R&D initiatives in energy for SANEDI, including hydrogen, energy storage, renewables, and gas technology innovation. Paul Eardley-Taylor, gas sector lead at Standard Bank. Paul is responsible for Standard Bank's gas sector activities across sub-Saharan South Africa. Paul has 27 years experience in energy corporate and investment banking. He focuses on upstream, midstream, and downstream gas projects, as well as energy transition finance. Mzi Teokolo, Group CEO of Springlights Gas. Mzi brings over 2 decades of experience in the gas sector. He has led SLG through strategic expansion, looking at the future energy supply options and independent power production. He is focused on innovation, infrastructure, and clean energy development. James Mackay, heading the Energy Council of South Africa. James is a qualified engineer and finance professional with extensive experience in both public and private energy sectors. James formerly led the energy strategy section at PwC and now heads the Energy Council, involved in shaping national energy strategy and policy. Welcome to each of you. And over the next 60 minutes or so, we certainly look forward to listen to your insights. I want to start with part 1 of our conversation today, which sort of focused around demand policy and this whole issue around urgency. And James, if I may start with you, if you look at the IRP24, of course, and the gas demand forecasts in mind, from your perspective, how firm are these projections, and what are the policy levers we need to align demand with infrastructure rollout? We're clearly running out of time. We've been sitting in this purgatory position probably for the last 10 years. You know, if you read gas documentation going back 15 years and you read documents today, it seems like we're regurgitating the same thing over and over with very little alignment between reality and policy. But please share with us your views around these forecasts and what do you think are the policy, what needs to happen in the policy space to get us out of the starting blocks.
Thanks, Jaco. Good afternoon, everyone. It's great to be here. If I think back, yes, Jaco, with great frustration, I worked for probably a few years in the gas to power program. We did LNG import feasibility studies on infrastructure and terminals back in 2012, 13, 14. I think the first point, I agree with you that this is long overdue. We need to make some firm decisions, and the indecision has caused us to be sitting in this little bit of a policy vacuum where we're not sure if we can move forward, but it's got a little bit more and more desperate. I think we have to also recognize that to try and project what our energy mix and things are going to look like in 2050 is this sort of crystal ball gazing. And so certainly as the Energy Council, we have said, let's focus on the next 10 years. If we can get through this front end of our energy transition, we will be well positioned to go through to 2040, 2050. So we've done sort of modeling, which we called last year our energy transition roadmap. This was helping us to form a strategy and position on many of these positions, which we'll redo this year. The position on gas that we took is that we urgently need to move on gas, but gas is not a base load supply or technology in the system. It's needed for specifically balancing peaking and capacity, so long duration storage. And so it has to play a role, a bit of a filler role in between this shift out of sort of traditional base load thinking and centralized planning and structures into a variable and much more flexible system. So it's got a very important role to play, but it's not baseload. It's a combination of, I think, high mid-merit, which creates a nice bankable offtake, but then a fair amount and quite a lot of peaking capacity. Our modeling indicated we would need sort of above 5 gigawatts installed by 2030 and sort of a little bit above 7 gigawatts by 2035 in order to balance that mix. That would give a sort of offtake in the power sector of roughly 70 to 80 petajoules per annum. I think one has to then marry that with the realization that, and you've been very kind of clear on this in the public domain, we're running out of indigenous cheap Mozambican gas in the Romco line. And so how do we marry that power demand with the industrial demand? So as you said, we've got 180 petajoules roughly coming through the Romco line. If we take the Sasol usage out of that and we just reflect on the industrial, out of that 70 petajoules of industrial demand, in our view and numbers, probably if you take steel, retail, glass, that's about 50%. The other 50% is very much processed thermal manufacturing foods. So if we are switching to LNG, that industrial demand has to be able to accommodate a 5 times increase on the input price of energy. And probably the view is that only high value added processors would be able to afford that. Now, that's no one's fault. And I think what we're already seeing in the industry is that there is switching to alternative fuels. Unfortunately, that includes coal and HFO. So our view is if you combine then a sort of balanced outlook of gas to power with the sort of affordable side of industrial gas demand, you get to the 100 petajoules, which I think is enough to bank an LNG import infrastructure and terminal. And we have 2 good engineering solutions through Richards Bay and Matola. So then it comes back to who is going to underpin, whose balance sheet is going to be put up to underpin the infrastructure, the market aggregation, and the supply risk. And that is where I think the impasse has happened, where there's an expectation that it can be pushed onto either Eskom's balance sheet as backed onto the government, or alternatively kind of coordinated and aggregated in industry. And as far as I'm aware, Sasol have consistently been clear that they would not put up their balance sheet to play that aggregation or integration role. And so the default has been, in a sense, to request public sector to be able to backstop that. And then the last point I'll make, and then I'll hand back to you, is that I think we've got to be very cognizant of the reforms that are in place. The ERA is legislated, which means we move from a centralized planning and utility structure. We're moving into a liberalized market, unbundling of tariffs. So when the market launches next year, we have separate price signals and competition for energy itself, but then for balancing capacity and reserves. So if we look at future technologies and investments, we've actually got to say, how will that be sold into the market? What does it supply? And gas is flexible because it can supply energy, it can supply peaking in terms of ramp rates, and it can supply capacity and reserves. So I think that the risk transfer model of who carries this and how do we pay for gas has to be looked at in light of the current reforms and the move into the market. And on that basis, I think then we would be able to probably move on a business case quite quickly. But I don't believe that we will find a single balance sheet just to be able to absorb all of the aggregation and infrastructure risk. I'll stop there. Thanks, Jaco.
Thanks, James, for those insights. I just want to draw a little bit down around you mentioned 3 things here which makes me think. The one is crystal ball gazing, and where from our perspective, from an industrial perspective at least, we see this continuous crystal ball gazing as actually hampering decision making, and it comes back to your next point, I suppose, in terms of what is baseload and what is flexible power in the gas to power space. We certainly see the need for flexibility, but we also see the need for extended renewable energy expansion. So the 2 certainly needs to run in parallel in order to balance out the system. All right. And I think at both ends, we are light years behind in terms of allowing the growth of those 2 energy types in the country. The other one is around pricing, where you mentioned 5 times the gas price. I mean, in our opinion, LNG is more expensive. It comes back to something that I read in the draft IRP, where the government pegs gas pricing at $15 per gigajoule, which in our opinion is quite high. All right, it's probably 50% too high. So so the 5 times number, and what in your opinion is the real economic value of gas per gigajoule going forward for industrial and power usage?
Jaco, there's one or two things there I think we just must reflect on. Firstly, if we look at the IRP, the role of the IRP is changing. Previously, it was the trigger for a Section 34 procurement out of public sector backed onto the country balance sheet. If you look at the ERA definition of what the Section 34 determinations are now, it is to prevent market failure. So the IRP becomes a guideline. The 17 gigs are identified in the IRP at the moment. I think technically we've disagreed with, because it's there as a proxy for a baseload system, a central planning system, which is providing 15% reserve margin. But we know that as we move through and we introduce more flexibility, you don't have a straight one-to-one reserve margin. You also don't replace baseload one-to-one. We've also got to reflect on the fact that we've got an extension of coal. We've done that, I think, in a positive way to get out of load shedding and ensure energy security. So those aspects are very important. We don't have time to go into the detail, but I think, listeners must go and look at the changing role of the ERA, the impact of the IRP, and the role of government in the marketplace, a liberalized marketplace. Also, the extension of coal provides now actually a surplus of baseload as we move forward. So we really do need much more flexible and peaking power, and we need it urgently. So we need to make that decision. When it comes to the value of that, and we've seen a lot of examples around the world, Australia is a good example where actually they built too much just straight flexible energy, didn't have enough balancing, really ended up actually turning that on its head, and the value of balancing energy in the system became so attractive, no one wanted to build any more energy, but all they wanted to do was build batteries. So what we do need is a balanced and transparent level of price discovery. That is the point of the introduction of the market. If we have good price discovery, gas will be viable, it will be attractive, and I think the private sector will be able to build it because it will have more than just energy, it will have balancing, and it will have capacity value. If we could use that to bank the infrastructure risk, I think that not all industrial users will be able to afford, whether it's a 3 times or a 5 times uplift. There is a distinct uplift, and low value thermal processing on energy is going to struggle to pay for that out of LNG. So those are sort of kind of tough industrial economic questions which need to be better analyzed and understood, so that we can have a business case for gas that is now framed under the new ERA, the policy reform agendas by government, rather than just assuming that it's going to be banked by public sector, which I think the reform program doesn't allow the traditional business case in what we should have done in 2014-15. We now have to be more innovative and more creative around how we bank and create that business case. Thanks.
Thanks, James. Professor Mamphele, I mean, from your perspective, I mean, why has South Africa found itself in such a compromised position regarding gas energy and, of course, electricity security? And I think we would also be interested to hear from you, how do we ensure this doesn't become a long-term failure?
Yeah, so thank you so much, Jaco. And I agree with some of the sentiments that James expressed. So why we find ourselves in this particular situation when it comes to the gas side of things, it's mainly because we haven't done a lot more exploration of our own indigenous gas resources. And that is mainly because there is quite a lot of issues around that are brought about by environmental groups. For instance, once the private sector starts with the exploration that is allowed by the then Department of Mineral Resources and Energy, you would have environmental groups opposing those explorations all the way to courts, and the court processes take long. So that on its own adds a layer of a risk. So the private sector does not really want to invest a lot of money in exploration when they know that the risks are much higher, that they might not be able to forge ahead with such exploration. So it becomes a huge risk on the investment side of things. Now, we are left with an option of importing the LNG. And like James indicated, some of the imports, the gas imports from Mozambique, that line is running dry quite soon. That's why we have that's adding to the so-called gas cliff. So while government in the main supports the sector in terms of issuing licenses for exploration and things like that, we have those kind of challenges. On the security of electricity supply, we have a history of that, where we basically did not build enough generation capacity for quite a long time. And also the issues around the lack of proper maintenance on the existing fleet, especially the coal fleet. And we now know that through the President's Energy Action Plan, we started with the robust kind of maintenance program supported by government and being done by Eskom. That's why we have seen now the kind of a reduced load shedding. Now, I just need to indicate this. While things may look good as things stand, we don't have load shedding. Eskom is going to have to decommission quite a substantial amount of megawatts by 2035. And that brings in a huge uncertainty. So we're most likely going to see, if we don't act now, which is something that James alluded to, if we don't act now rather than later, we might see a much intensive load shedding beyond 2035. The IRP has got all those numbers showing what could happen beyond 2035. The issues around the grid, which the minister is trying to deal with through a program similar to the REAP program. Now, while the minister is busy with those, the new program that he has introduced, we are yet to see how that will pan out, mainly because just to build the power lines, you need to negotiate servitudes. And the negotiation of servitudes take quite a long time. The minister is looking at using the Expropriation Act after negotiations, obviously, to expropriate land, but with compensation in this particular case, so that we can build the 14,000 kilometers of lines that we require. So that is something that I just need to flag to say we need to deal with our grid capacity. And on that one, we confident that the private sector will come on board. On the gas side of things, like what James indicated, it's not yet clear whether the private sector will be able to come in and play a role. However, if government comes on board and play the enabling kind of a role when it comes to the importation, for instance, of the LNG, the building the required terminals and the FSIUs that are required for the import of gas in the country, and also with the liberalization of the market or on the electricity side of things, we might see things improving. But all that needs to happen on an urgent basis, I must say.
Thank you, Professor. Paul, if I can turn to you and sort of ask you a two-way question. The first part is what your views are on the energy balance as reflected in the IRP, in the industrial space. Obviously, in your role, you are very close to the markets and what is needed and what is required. And how do you see this debate playing out around the energy transition on the one hand, the need for energy security on the other hand, and of course the role of gas within that? So that's sort of the first part of it. And then, of course, we also very interested to hear your perspectives on the regional developments and how this can impact oil and gas activity in South Africa, and of course provide us with those potential prospects that we have. On the one hand, we see a set of economics on LNG, but of course LNG is a necessary step, an expensive step for the country. We reckon LNG cost us, as opposed to the domestic gas, in the region of about $4.5 billion a year. On the lack of domestic gas. So I'll certainly be interested, and I'm sure the group as well, is to listen to your perspectives on those two matters. Thanks.
I'll do the second one first. So I'm in Swakopmund today, where one of the main securities houses in Namibia has just held their big investor conference, hugely well attended. And it's really a testimony to the speed at which the region is transforming. As at today, Namibia looks like it's going to be producing 250,000 barrels of oil a day by about 2030. In terms of gas, what's significant is the scale of Namibian gas. So even though they are re-injecting the gas at first, it's public domain that Total will be re-injecting about 550 scuffs a day, which is the equivalent to Sasol's entire Panditamani production, or Coral FLNG's LNG production. Speaking of which, Mozambique is continuing to make inroads on LNG. Literally yesterday, Mozambique's Council of Ministers approved the plan of development for Coral North FLNG. That's their second floating LNG project after Coral South. So they'll have 7 million tons of floating LNG by about 2029, plus Mozambique LNG, 13 million tons, plus Rovuma LNG, 18 million tons. And there's really two significant points for South Africa to start teasing out of the neighbours. The first one for Namibia is, if Namibia has massive resources in the Orange Basin, then so does South Africa. So in terms of policy making decisions going forward, the reality of the Orange Basin must become part of South African decision making, because Namibia will go ahead with this. And therefore the choice is, does South Africa also develop its own Orange Basin or not? In terms of Mozambique, what Mozambique's impact on South Africa is really a pricing cap on the LNG imports that South Africa would have. Because South Africa long-term needs a certain amount of million tons, somewhere between 5 and 8, something like that, Mozambique will be producing 38 million tons next door, or in petajoule terms, 1,900. And because Mozambique is so close to South Africa, the shipping costs are likely to be very small, going from Mozambique to SA, and depending on variables in Asia Pacific, the country really can get some quite cheap LNG pricing. In terms of the first point, I think what's become clear over the last 12 months, but really over the last 3 years, is there's a lot more definition about the shape of the transition. Some of the views of the transition that were put forward in 2021 are not really, it seems, particularly accurate at this stage. They can be forgiven. Technology evolves. Clearly, energy demand is going one way and one way in total, and it's going upwards, whether it's data centers, whether it's AI. Some of the inherent challenges of variable renewable electricity have becoming more widely known. Issues around balancing, issues around weather dependency. That's from the electricity side. But what is also clear on the technology side is gas has been more widely used. One of the things we're looking at very closely at the moment is LNG trucking in China. So Chinese diesel consumption is not just reducing as a result of EVs, which are often talked about. It's also reducing because of LNG trucking, and it's taken a significant percentage off diesel demand. And some of the other industrial things to talk about, which also form relevance for the South African case. Marine bunkering is a good example. So the global shipping fleet moving towards cleaner fuels is being led by LNG. And one of the factors that's holding Africa back at the moment is, in contrast to Europe and Asia Pacific, not a single African port has marine bunkering for LNG. So you think about the South African ports, Cape Town, Saldanha, Richards Bay, Durban, they also need to increase marine bunkering. So I think where we are at the moment is there's a bit more definition around the transition. Renewables has got a role to play. They're very much electricity focused. But if you go across the four sources of demand for gas, industry, heating, transport, electricity, renewables can only compete with one of those. Thank you.
Thanks, Paul. Mzi, from SLG's perspective, I mean, what is your 5, 10, 15-year vision for gas energy in South Africa and its place in the energy mix? Can you hear us all right, Mzi?
Yaku, thank you for that. I was just saying the aptness of this question is also informed by the fact that we have been trading natural gas in the country for the last 22 years. So certainly we do have a view over the long term as to what the role of gas then will be in the country. And I think, though, if one takes what has been said, both from when James started to, I love what Paul's just spoken about, because Paul is actually transitioned to a view that says the world and the region has got a future view of a gas playing a lot more significant role in the energy landscape. And I must say, SLG shares that sentiment in both what we do today to future-proof ourselves and our belief in that future. It is unfortunately, and sometimes we get stuck in it, is where we are, is in that transition that needs to enable that future, right? So that future is, you started it with your opening, that South Africa, and we cannot buck the trend of the world. I mean, baseload power on gas is not only in existence, it's effectively a growing trend. We are talking an average of between 20 and 30%, depending on what numbers you're looking at, where gas plays a baseload role in power generation. And that comparative to South Africa, I mean, we don't need to repeat ourselves to talk about peakers that are running on diesel. So it's insignificant comparatively speaking. So there's certainly a major role, in my opinion, for gas to then play a role in our primary energy mix, just that. By the time we then transition to the other three nodes of demand, which Paul has touched on, which is, of course, our commercial and industrial market, which is our current focal point, and our reason for existence, there is definitely a growth that needs to come out of that. And as a matter of fact, I always laugh at, sorry, I don't laugh, I just frown at it as a concept. South Africa, on one hand, talks about an industrialization program, and yet you don't want to enable the primary energy that fuels that industrialization and does it competitively with the world. So if we are talking about an industrialization of this country, which is a much needed economic imperative to drive economic growth and create the much needed jobs we need to start thinking seriously about gas. And SLG believes, therefore, that there is still a very strong future in gas as a primary commercial and industrial energy source. Then, of course, I like what Paul just touched upon now. If you look at only our heavy-duty trucks around the country, and of course the fact that South Africans depend on public transportation to move around, let alone, of course, that we are a very highly mobile society. It's a very untapped and with great potential growth node for the use of natural gas, because the world is moving. And interestingly, the technologies are growing in that space as well. So when you look at all of that, effectively, one then cannot only just really be excited about the prospects of growth, let alone the frustrations, but just the prospect. We certainly believe that the next 10 or 15 years, and it's also a translation of talking about gas as a transition, I don't think so. I believe gas is a destination fuel, and it should remain as such for at least, in my opinion, circa 2050. Because if you look at every statistic or whatever publication you want to think about that tracks these global developments about natural gas, there's enough gas to not only maintain current production and consumption of natural gas around the world, but with the projected growth for us to go well beyond 2050. Now, if the entire globe is taking that view, I think it's counterintuitive for us to be thinking of going the opposite direction. So we should rather be focused more on how do we enable gas becoming a reality in this country. And that is, I'm assuming, amongst other things, part of the conversation that we want to have. And I must say, in conclusion, it's that as a trader of natural gas who is currently undertaking an aggregation role, and it's important to understand this, because it's South Africa and the way we do things, it's become the traditional aggregation role, which is often driven by government or underpinned by government activity. This is us as private sector players consolidating demand in order for us to enable the upstream investment that needs to happen so that we ultimately can start talking about an LNG market that fuels the gas economy that continues to exist over the next 15, 20, 30 years, because it's certainly a much needed imperative for where we're trying to go. So I suppose just in sharing our thoughts and what we're trying to do, that's the reason we come to the office these days, because we, as you know, you've said it, we're selling a commodity which we got from Sasol and other suppliers, but it primarily comes from Mozambique, and it's getting to the latter end of its lifespan, and for any continued existence, we need to really start thinking about what is the next. And yeah, I sit here with jealousy when I hear what Mozambique is. Mozambique is one of those, we fell asleep at the wheel and the ship has left. But when I hear what Namibia is doing, the urgency they're dealing with things, the decisiveness they have, the consolidated effort Namibia is putting into making sure they extract the gas that's on their shore. I sit here only wishing that we as South Africa can just copy and paste that effort alone, because we certainly have a lot going for us to be able to not only catch up to our neighbors, but probably be on par, if not surpass them, because we have the economy to drive that demand.
It certainly sounds like there's a bigger reality setting in around the future role of gas and the need for gas for industrialization, economic development, and energy security. We hear statements around, you said it, Mzi, around gas being a destination fuel. We hear the role of gas, and from our perspective, we certainly don't see a lesser demand for gas going forward, and it's probably anchored on these, to use a cliche, around the energy addition rather than a transition. The demand for energy is insatiable in the world. It's not going to stop. So I want to speed up the conversation a little bit around, around infrastructure, financing, and viability. And Paul, if I can maybe start with you. It seems like in South Africa, if you talk money and finance and de-risking, guarantees, structuring the fiscal space of these type of transactions, I don't see that we've got an upstream problem. Upstream, in our opinion, would probably be underpinned by large international oil companies making significant investments, not looking only at the South African market, but of course global markets, and hence a lot of private capital can be raised in that space. Our view is, and I want to put this question to you, as a question rather, it looks like we're sitting with a midstream problem in the country. We have the demand on the downstream, but we're really sitting with a midstream issue, and we're looking at each other to say, but how do we connect supply with the absolute real demand that we see? But from your perspective, I mean, what are the key investment priorities that you see right now in gas infrastructure, LNG or domestic gas? And how do you see the development of these fiscal frameworks to help us enable these investments?
Well, I think the first thing we'd say is there is a lot of financing appetite for well-structured energy projects. To give you a couple of examples, we have lent billions and billions of rand to South African renewables, the schemes over the last few years. We've also been part of the battery schemes. To give a natural gas example, in terms of overall commitments and appetite expressed to LNG next door, and I'm sure MZ will say something when he hears this number, we put numbers out there to clients of well over $1 billion US. So there is appetite there, and it's been demonstrated and proven, and we've literally just taken Coral North to our credit committees in the last few days. So midstream, we have to define the problem. The problem is not money. The money is there. It's the transmission mechanism for how, in the case of gas, the gas gets from the upstream piece, the LNG, and hopefully long-term the Orange Basin extraction into regasification or into pipelines into a power plant. And this is where we have, it's been a very, very South African problem. I mean, I always like to quote the example that South Africa is the only country of the G20 that doesn't have grid-connected gas to power. That remains the case. It does need to be solved. I think all the panelists agree that as a minimum, mid-merit needs to be done. So the real question is, how can either the legislation be fast-tracked, the regulations be fast-tracked, or the policy be made a little bit more flexible within the boundaries of the Constitution? My own view, and there's lots of other views, is that the best legislation on gas globally in the last 3 years was the German LNG Acceleration Act. It didn't change a single piece of underlying legislation. All it did was it amended all of the existing German legislation to allow for accelerated timelines. You still had parliamentary debates, you still had regulatory public hearings, but the outcome was that Germany got its security of supply within an LNG sense within about 9 months. So some of the suggestions that are out there, obviously the gas cliff, getting Matola done, getting ZET done, getting the gas to power program going with at least 2 or 3 programs, they seem absolutely ripe for a variation on the German LNG Acceleration Act. Thank you.
Thanks, Paul. James, turning to you again. You also touched on the underlying risks, and who stands good for these billion-dollar investments that needs to follow. What are your views on these fiscal frameworks and the capacity of the South African government to take on some of these risks which are in the national interest?
Thanks, Jaco. I do think also we've got to be careful of bucketing too many variables into a single sentence with this gas issue. I agree with Paul and MZ's views around upstream. I think that there's opportunities and that should be dealt with in the appropriate upstream framework. However, I don't think that that's a proxy and that doesn't solve gas to power and the replacement of the current really cheap domestic gas that we've had. And that is a burning issue. It's something which we've got to resolve quickly, which I don't think that upstream development is in the same timeframes. So I do think that if we have to be very practical and we're going to focus and say, well, we can argue the number is it 2 times or 3 times or 5 times. The reality is we've had a readily available cheap domestic gas that has been used for low value thermal production in foods and general industry. Those industries will not be able to afford LNG. So some of those will have to find other alternative sources of energy. Unfortunately, that is going to be coal, HFO, and others. Okay, so from an emissions perspective, we're actually going backwards. However, what portion of our current industry can afford LNG and at what price? Now, if there is a long-term upstream play that says we can get cheap LNG or cheaper LNG from Mozambique, then we're going to have to understand that and integrate it into that sort of business case very, very quickly. But as it stands, I've yet to see any example. Paul, you're welcome to tell me I'm wrong here, but once you've got LNG and you're saving a bit on the shipping costs out of Mozambique, it is not substantially cheaper. Yes, it might be a little bit cheaper, and it is going to take time. We have lost a lot of industry and our economy is really struggling. So where's this affordability and big industrial demand and big industrial growth? In the timeframes that we're talking about closing a deal here, that's just not readily available. If we then pair that with the power demand, and I'd like to go back, keep referencing IRP. Well, IRP clause 6, if we look at it, actually says that renewable energy is the cheapest form of energy and is attractive in all scenarios. Okay, and the IRP actually says we need to consistently build between 4.5 and 5.5 gigawatts of wind and solar per year. We must recognize then actually that we've gotten this extension of coal. So we've got an announcement and an investment of at least 5 years, even on the small stations, and longer on some of the big stations. And that's been referenced in the IRP as well. So when we look at the role of gas in the power sector, well, if it's straight energy, gas is not going to be able to compete on cost with renewables. If it's peaking, well, there's a little bit of kind of competition as batteries come in. If it's capacity, well, it's competing against extended coal. So the role of gas is nuanced, and this is where the business case, I think, by just saying that we're going to have, a gas master plan that somewhere we're going to have huge industrialization, is creating a business case which I think is not bankable. So we know there is a Section 34 determination for 3 gigs of gas in Richards Bay given to Eskom. Transnet has partnered with Vopak for the midstream piece that you correctly referenced. What we've got to quite quickly couple, I think, is the missing part here, is at what price. If we have at what price, it will make a difference on how competitive that power will be into the future market and the unbundled tariffs as are referenced, as well as how many of the current industrial demand will be able to convert. Then we've got a view on what demand is bankable, because actually there will be a case to sign up for it, because you can either sell it in the power markets into SAWIM, or you can take offtake agreements into industrial users. And as long as we can get that demand to a sort of, I think, the 80 to above 80 petajoules, we have a bankable business case. Then it's going to be the hard work of integrating that and getting the risk model so that we can actually move forward and make a decision. Taking that business case and then saying that that is equal to sort of building and committing 17 gigs plus and sort of upstream, I think it's a step too far, Yaku, because we just don't have clarity. We don't have that direction. And certainly the policy doesn't yet support it. Thanks.
James, thanks. I think from a systems operator perspective, energy or electrical energy that you're largely referencing, I mean, it is not either or. I think there is a world where there's a need for gas and renewables, which will result in that center of gravity or lowest point of energy. The other demand for energy around industrial transportation and so on, I mean, these are also real and critical issues, which is not only hinged on LNG, it's also hinged on the potential of the potential for domestic gas, and of course that unique set of economics that are associated with that. I want to move on. I'm just mindful of time, and maybe turn to Mzi around the question, if you consider the private sector roles and the innovations that we foresee, Mzi, how does SLG promote sort of cleaner, more sustainable energy solutions, and how do we see gas as enabling this?
Jaco, perhaps the first is to start with saying, I think we've sort of drawn a very solid and direct line to cleaner energy equating to renewables. And I dare or sort of remind everyone that gas in itself actually earns a badge in that space. Simply by, if you take base load that's coal generated, you probably reduce emissions by up to 60%, if not more, depending on the technology, just by burning gas in its stead. So if you're looking at a very coal-heavy base load environment like ours, we always almost think that for us to get cleaner, we got to move from the coal to renewables. and as great as that is for let's call it electricity that is required in that sense, but when you talk about direct heating and all these other sort of industrial processes, you have to start thinking about what else is cleaner than what I currently have. I mean, James touches on when these guys that are currently on pipe gas move back to something else in the absence of either gas or a more expensive option, they're going to go to energy fuels that are bottom of refineries like HFO, oil, which if you burn that, not only are you dealing with very unpleasant sort of emissions, you're introducing a whole host of other chemicals into the environment. So to circle back, just the mere fact of being in the business of gas already contributes significantly to a much cleaner environment. We all know this by vehicles. I mean, the smog that you get when you sit in winter in the middle of Johannesburg. There's no power production plants in Johannesburg. That's vehicles driving around. If half of those buses or those bus fleets and the trucks driving there were gas, you'll be producing carbon dioxide and water vapor. That's pretty much all you'll be producing from burning your vehicle. So we will, and that's why this is our primary business, continue promoting the role of gas. And our view then is the wider and the bigger that role is, the stronger our contribution as an industry is in cleaning up our environment. And of course, I mean, once we get into the merits of which one is better than which, again, interestingly, when and maybe it is this again, when you're looking at a world where we have a coal-based load, which is supported by renewables, which is, as I said, the key focus. What happens when we do the proverbial or go there, the sun doesn't shine like we've had in Durban for the last week, and there is no wind? Are you gonna burn more on the coal that we already have in the system because we keep resisting moving to gas? And that's this sort of transition role gas is being touted for as a support fuel to renewables, simply because, and I've seen it happen, I can start a coal power plant, and by the end of a couple of hours, we'll have power coming out of that plant. Unlike coal, you can't do that. Mm-hmm. So Yaku, it needs to remain on the table that gas is substantially critical in the planning that we need to do, whether it's to transition from the old coal fleets that we have, which I must remind, Professor was right at the beginning. We're focusing on replacing the deficit now. What happens when we switch off the other older coal-fired plants? Not about maintenance. Those things are old. They will get to a point where they will break. And if you're looking for a 3 to 5 year horizon of how quickly you replace them, I don't think we have enough land to build solar power plants. We'll need to put up gas power plants for our base load. So yes, we again want to reiterate, gas not only is from a convenience technical availability of it, and then you obviously go to the role it plays in supporting the grid that the professor said we need to expand by another 14,000 kilometers. It is, when it's all said and done, a much better option for our environment, given the space that we are as first the country and as a globe.
Thanks, Professor Mampwele. I mean, we could probably spend a day and a half on this particular topic, but just from your perspective, what is SANEDI doing to advance the research and innovation in gas technologies, and particularly those that support decarbonization, affordability, and energy access? I would like to sort of conclude this section of our conversation with that question to you, Professor, and then I'll turn to the panelists just for final let's call it a full circle reflection on the conversation again, and then Shannon, with your permission, then we'll probably go a little bit over 3 o'clock. And then maybe deal with some questions and answers from our audience. So, Professor, please, if you don't mind, just sharing us very briefly your views on the technological developments in the gas energy space.
Thanks, Jaco. Yeah, like you indicated, we can spend the whole day talking about what SANEDI is doing in the space, in the energy space in general, and also in the gas space as well. So SANEDI is a state-owned entity, a Schedule 3B company under the Department of Energy and Electricity. Part of our role is to conduct research, to direct research, national research, to also advise the Minister of the Department of Energy and Electricity and the Department of Science, Technology and Innovation. So we're doing quite a lot of work on energy planning. So the IRP, for instance, was done through the Department of Mineral Resources and Energy in the past. Now it's being done through SANEDI. The energy mix that goes into the IRP, we going forward, SANEDI will be hugely responsible for that. I am aware of the 17 gig gas allocation in the current IRP draft 2024, which is going to be IRP 2025. We've looked at various options with the modelers, looking at how do we bring in the gas in, including looking at the gas as mid-merit going forward. Now, the other aspect that we're looking at is the hydrogen side of things. Now, I talked about the issues around the gas cliff, which we all know. And I'm happy that there are other developments in the SADC region around that. But we're also looking at the hydrogen side of things. SANEDI is doing extensive research through working with the Department of Science, Technology and Innovation on the hydrogen economy. The big hydrogen projects, we expecting huge investments in the hydrogen side of things. Including renewable energy. We are expecting about 59 gigawatts of renewable energy that will be coming as part of the investment in the hydrogen economy to support what we call the catalytic projects. Now, the question then is, how do we then work that into our long-term energy planning, which we are going to do. It's not in the current IRP. We just have a few lines in the IRP around the hydrogen economy, but we're still going to do to run a number of models. Now, in conclusion, as an entity that supports government in decision making, we see the role of government as being an enabler. Creating an enabling environment for the private sector to come in and play a bigger role in the sector. You know about the reforms that we have that have been introduced. The new electricity market that is coming. We are of the view that that will also open up space for the private sector to play a bigger role in the gas side of things. And we think that we have the view that government should assist in terms of building the infrastructure that is required and then open up that particular space for the private sector to come and play a much bigger role in the space. Thank you.
Thank you, Professor. I think if I can turn to our panelists one more round and just very briefly from each and every one of you, I just want to conclude maybe with questions and insights from yourself. James, if I can maybe start with you, in particularly around the, if clearly if we delay gas procurement decisions, there are certain consequences to the economy and of course industry and of course power generation as well. What do you believe are these particular consequences to the country if we don't if we don't make these decisions very quickly.
Thanks, Jaco. We are at quite a critical stage of our reform agenda. We've done very well over the last 18 months, far better than whatever anyone could have expected. But what we do now up to 2030 will either set us up on a platform for success through 2040, 50, or we're going to end up back into a full-blown energy crisis. That would likely look like a lack of integration, a decoupling. You're going to have a lot of private sector renewables sort of, which has been largely deregulated and facilitated. If you think of what's been done to enable private sector investment, which is responding incredibly well. I think that the renewables developer industry is growing at probably 30-40% year on year at the moment. And then you will end up with competition against public sector and with competing assets, which actually can't compete, but we need all. And then lack of decision-making in the middle will mean that we don't have enough dispatchable power, we don't have demand-side response, we don't have peaking. So that will not only end up in a commercial risk failure, but it's going to end up in a system instability issue where ultimately you're going to have either an overbuild and sort of legal commercial connotations, or you're going to have instability, especially with a duck curve and peaking time, and the system operator is going to start having to intervene and force and make decisions. So I think that we've got to move. One of the things that worries me in this conversation is actually very reflective of what we hear in the marketplace. And gas has this unique role. It's very nuanced, and there are too many narratives which I think sometimes conveniently pick a position. And what we do need to find is a more balanced and a much more clear and structured argument for gas. So I do think that if, very practically, we need to move on probably 5 gigawatts of gas to power. What is not clear is the mix, the load factor. So what is the load factor? What's OCGT, CCGT? I believe that base load will not be necessary and won't compete, but we do need a good mix of mid-merit, which is enough to bank it, and we do need some extra peaking. We've got adequate locations, good engineering, I think, solutions for that. So the next question then will be, how do you sell that power? Well, it has to be sold under the new ERA legislation into the market that will be launched. And so on that basis, you have to say, well, will that gas to power be sold by public sector, private sector as peaking, balancing reserves? What is the price signal for that? And then we have got a clear understanding of that business case. Under the ERA legislation, the role of government and the IRP and the Section 34 determination changes, because the minister actually needs to look at the market. And if he identifies that there's likely a market failure, so that we're not building enough balancing or we're not building enough reserve capacity, then he uses a Section 34 to intervene, which can include supporting infrastructure. So I think that we've got good legislation. The minister is better positioned and entitled to intervene in the supply chain to get it done and support those areas where potentially there's a risk mismatch and it's not bankable. But it's a different form of structuring, and the gas master plan doesn't look at it in the context of the reform agenda. It looks at it as just demand side driven. So I think we have to go and re-look at some of these concepts in the business case in line with the reform agenda. And then lastly comes to the financing. And I think that's got to be a combination of public sector, private sector. But, at the end of the day, we hear often in this conversation around gas that, public sector, balance sheet, National Treasury, Eskom are having to step up. But, if we are going to sell this and the policy and ERA says we are supposed to be creating competition, opening up a price discovery to reduce price for all consumers and create efficiency, then we've actually got to look at how will this be used and sold into the market, and who's going to consume it, and can they afford it? And our reality is that we're a 1% GDP economy targeting to get to 2, with an ambition to get to probably 3.5. So when we say, there's going to be this insatiable demand forecasts across both GDP, industrial, and power are low. And so I think we've got to be very focused. We can get this away. We can be focused, but if we over sort of amplify this as a 10, 20-year plan, I think we're going to just get into further and further delays. But if we kind of really get focused, we reduce this to project number one or phase number one, we actually do now have better mechanics than what we did a year ago, pre the ERA amendment, to build a better business case and actually kind of close this and get the ministerial support and government intervention that would be required to bank it. But we've got to be careful of kind of creating this as an all sort of singing, all dancing solution that will be servicing for the next 20, 30 years, because then we get back into that crystal ball gazing, and I think we lose the bankability of the business case. Thanks, Jaco.
Thanks, James, for that. Mzi, how would you describe Springlight's sort of top strategic priority to help bridge the gas gap that we see, and what support do you think is necessary to really unlock that momentum?
Yeah, I think the answer that I have is going to be centered around your last point. How do we create the required momentum to actually just get us to the solution? Actually, Paul shared a very nice slide in Cape Town about how first world economies who have got energy security have got relatively high GDP growth rate. So it seems simple, but it's pretty much, I think, right in front of us. The top and better performing economies around the world are not sitting wallowing about their energy options. They're very decisive about it. They've got a mix, and their gas plays a significant role. They talk about one thing: energy security, because energy security creates economic activity. Economic activity creates the GDP growth that we want. So I want to conclude that by putting and this is a firm belief I have, and it's the work I'm focusing on with my team to try and drive and enable, is that for us to bank South Africa's energy security business case, we need power to lead that business case offtake. So it's a function of revenue security. And right now, the most dependable revenue security we can have is that South Africans need power, and they need it reliably. So gas needs power to lead the gas economic development. I believe then that would, of course, require government to take a very decisive role in terms of how we buy the power, and make the decisions of whether, right now in the GIP program, we're still waiting for a bit, like Note 11, which needs to decide or give clarity on what the dispatch profile is going to be, which really gives the certainty that, like Paul said, financiers want, midstream infrastructure developers need, and and downstream traders of this gas require. So that's the one thing. We need power to lead our transition. Secondly, we know that when that happens, industry follows that trajectory, and with industry comes economic activity and industrialization, etc. And then I believe on the back of that, we're going to have all of this innovation we want to have. We know the world is having about what's the best transport fuels, and that growth node is going to get its own sort of momentum to start really proliferating in the country. And then ultimately, we start bringing, of course, the enablement of other energy options and how they then can meaningfully contribute to our economy. But so in real conclusion of my little segment, we're looking for one thing and one thing only. It banks projects. It's done it around the world. Revenue security. And in South Africa, we cannot have that for the projects we are trying to develop on gas without power being the lead in that value chain.
Thanks, Mzi. Professor, maybe just a closing remark from your end is, the consequence of not having gas is economic stagnation and regression. The reality is since 2015, 10 years now, not one single additional molecule has been made available either for power generation or industrial use. We now are finding ourselves, and the consequences are playing out in the reality. The consequences of all of this is that industry is already looking across border, regionally, in order to where to invest and establish footprints, manufacturing and employment footprints. The other reality, of course, is that all critical investment decisions and growth has been put on hold for the last 4 years because of this overall uncertainty. How do we utilize gas to bring and inject that in the industrial space to ensure that we do follow that economic growth path, to have energy availability, and of course, not only for electricity, but also for those sectors that Paul referred to, the industrial transport sectors as well. Thank you, Professor.
Yeah, that's a difficult one, but I agree that, without us exploiting our own gas reserves, it becomes a challenge, and the private sector will obviously look at where else can they get the gas, and they'll look at the international market. I can tell you now that as SANEDI, we've been looking at the various technologies, what's happening around the gas market, the gas turbines, the manufacturers of gas turbines and things like that. And the results of that is that if South Africa wants to play a meaningful role in the gas sector, we need to start placing orders now. There's a huge backlog for gas turbines around the world. If we place orders today for gas turbines, we'll get them in the next 3 to 4 years. So we need to fast track placing the orders. We need to fast track our planning around the gas infrastructure. Like I previously indicated, government needs to play a leading role in 2 things. One, it's identifying areas where we can get gas while we're dealing with our own internal challenges that are rocking us in terms of our own indigenous gas. The second one is to open up the space for the private sector to come in and play a meaningful role in both the gas supply and the gas utilization side of things. So government needs to play a much bigger role in our view. I can indicate here that already the Minister of Energy and Electricity has been looking around the world. He has been to places like Qatar, sent there by the president to look at whether the country like Qatar can provide us with gas and at what price points and things like that, because we understand the local environment and the fact that it will take us up to 10 years to develop our own gas reserves. So in the main, we need to fast track the participation of the private sector, and also we need to fast track the infrastructure side of things.
Thank you, Professor. Paul, maybe over to you as a last comment or question. As a representative of large industrial gas users, we make it our life's work to understand the price of gas. We yet come across a broad inconsistency. If people refer to the price of gas, we see it in policy documents and elsewhere as well. What is the price of gas, Paul?
I can give you an opinion on what we see anecdotally from the clients. So we start at the bottom. Sasol's had access to the cheapest gas in South Africa. It was their own gas. It makes sense. It was in the order of $3 to $4. And by dollars, I mean MBTU or MCF. It doesn't really make a difference. It's only 5%. And the industrial users, they paid 7 or 8 all in. And then if we get to the power sector, they paid zero because they got zero. So then that's sort of the South African baseline. Where we see numbers today as to what imports can be brought in, let's assume South Africa buys Henry Hub linked pricing, which we think is probably the most sensible. It's the least volatile. It will be something like $8.50 to $9 landed. Then you'd add $1, $1.50 for regas, and $1 if you want to get it to the reef, or if you're consuming it at sea level, you don't need to pay that last dollar. So what does it mean for the individual sectors? So the way we look at it, if it's going in the power sector, baseload LNG to power is pretty much the same as Megaflex now. It's not a question of affordability. We can't afford that. It's a positive choice. You can argue things have gone wrong that Megaflex is so expensive, but that's the kind of the numbers. Mid-merit, we think, is just over $2. There's never been any mid-merit in South Africa. I think all the panelists are agreed there needs to be. And diesel to power, these numbers are public from Eskom and guys like that. They're about $6.50. So there's a huge competitive space in that mid-merit area, integrating it with renewables, combating Dunkelflaute, working with the batteries, stuff like that. Then to just briefly touch on the other two sectors. So if the industrials are buying LNG linked gas, it's not a huge jump. It's 40 to 50%. They're going from 7 to 8 to about 11, maybe slightly higher. So it's not a train smash. And then just finishing off, I talked about transport in the first piece. I'm going to talk about transport again. Diesel is normally about $30 a gigajoule, something like that. Maybe higher, maybe lower, depending on oil prices. We would guess, and it's a guess, we don't fully know, because there's only one supplier of trucked LNG in South Africa at the moment, that a long-term price could be in the order of $15 to gigajoule. So there is an increase in the case of industrials. There is a decrease positively in the case of transport, and in the case of power, on average, there will be an absolute decrease because you won't be burning the diesel. There is no mid-merit in the country. And of course, natural gas to power will allow load following capacity, as well as if there's a snafu in the coal sector, as happens from time to time. Thank you.
Paul, thank you very much. I would like to thank our panelists for a fantastic conversation, very, very informative conversation. Shannon, with your permission, you being the referee of our game today, I mean, let me hand over back to you and see if there's any time for Q&As from our audience.
Thanks, Yaku. There have been quite a few questions in the Q&A, but our panelists have very graciously also answered several of them. So just keeping in mind that we have sort of gone over the time and I don't want to take up too much of people's time. I do want to thank everybody for putting in those questions. I will pass on the questions to our panelists and then they can perhaps answer some of them after the session ends. But from my side, I would like to say thank you very much to our facilitator, Yaku Himan, as well as the panelists, Mzito Kolo from SLG, James Mackay from the Energy Council of South Africa, Paul Erdley-Taylor from Standard Bank, and Professor Samson Mpeli from Sanedi. A big thank you also to our sponsors, SLG and Richards Bay Industrial Development Zone, for their support in making this webinar possible. And finally, thank you to the attendees for taking the time to join us for this discussion on gas in South Africa. Our next webinar takes place on Wednesday, 23 April at 2 p.m. and will be on local manufacturing, focusing on the inputs, support, and incentives required to grow a competitive manufacturing sector. The link to register for that webinar has been shared in the chat. The recording of today's webinar will be sent to you all in due course, and if you have any additional questions, please be in touch. You can reach us at shannon@creamermedia.co.za. So I want to thank you very much for your time and see you in the next one. Goodbye.